Hello and welcome to this week's instalment of Nucleus Investment Insights. As China gears up for the Lunar New Year, the biggest global travel season of the year, there was a startling revelation from Chinese officials confirming the observation of a new strain of coronavirus. Officials from the Centre of Disease Control and Prevention confirmed yesterday that a newly identified coronavirus has now reached the United States. The virus, which has sickened more than 555 people worldwide and so far killed 17, was diagnosed in a patient in Washington state who had recently travelled to the Chinese city of Wuhan, where the bug is believed to have originated. In a similar vein to the SARS epidemic, the prospect for intense market volatility is high. As borders are closed, cities are locked down and quarantine areas are created across the globe. Here to discuss whether the coronavirus will create a market hangover is our Chief Strategist, David Llewellyn-Smith. G'day, David.
G'day, Tim.
And also our Head of Investments, Damien Klassen.
Hi, Tim.
Hi, Damien. So, and just a quick reminder before we get started to subscribe on YouTube to be notified of when we go live and have a new webinar to watch, and to follow us on your preferred podcast platform. So we'll jump into the agenda for today. So we've got the virus spreading coming into the holiday season and what appears to be a slow reaction, the Chinese reaction and the political necessity to stamp it out. We'll then look at some macro implications, a hit to Chinese growth and which sectors and for how long. We'll then turn our eyes to the Australian impact on tourism, students, commodities, etc. And then finally wrap up, as we always do, looking at the investment implications of a very big global theme on how we run models every day here at Nucleus Wealth and the MB Fund. So with no further ado, we'll jump into it. So David, the pandemic.
Yeah.
Hey, actually, sorry, can I just jump in quickly before we do that, before we get into what's going on? I just want to preface why we're actually covering this. Obviously, there's lots of different coverage you can pick up from various newspapers. Our angle mainly on this is looking at markets in particular. We've spoken about markets being quite expensive and economic growth relatively fragile, and the issues if you get an external shock, what you could see on the Australian economy. And this is something which at the moment isn't an external shock, but could easily turn into one. And so that's why we wanted to really focus in and look at the what the implications are for the various markets.
Okay, sure thing. All right, very good. David.
Quite right, Damo, and is developing into a shock pretty quickly. At the moment, we've got the number of cases rising about 100 a day, 17 deaths, and it's been relatively consistent at a 2% mortality rate. That's considerably lower than SARS, which is great news for everybody. It was up around some sort of 8-10%. Excuse me, but it is considerably higher than any regular flu or pneumonia. So it is a very high mortality rate in our day-to-day experience of disease. So, that kind of brings us to, can the data be trusted? No, is the answer. There are some credible reports that the virus is considerably wider spread already, and nobody has any clue. But there are reports, particularly in Wuhan, that hospitals are actually overrun. The PBOC the CCP, the Communist Party, has deployed its usual media control sniffers, and so nothing right now is credible or believable. But Western media is getting some information out, and even the official press in China can only hide it so much. And then there's sort of social media as well in China, which is leaking like a sieve. So all that adds up to it probably being a much larger figure already, and these numbers are probably being managed by the CCP. As a PR exercise. That brings us to a really difficult question for China right now, and that is where the timing of these things. It was terrible timing in SARS, and it's even worse now. In so far as it's right on the peak of the largest human migration in history, which is the Lunar New Year Chinese holiday. And so you're about to see the disease just crisscross China in every conceivable direction 1 billion times over.
Yeah, yep.
And so it's about to get a lot worse, in short. Now, in our next page, we'll see that they've tried to contain some of this in Wuhan at least. I'll come back to that. I'm finished, but it's already spread to any number of other Chinese cities. The cases are much smaller than Wuhan at the moment, but they're high enough for it to be accelerating. And so I do expect, despite what they've done to date, for it to get worse after the Lunar New Year holiday, and to have spread a lot further with much higher numbers. In how many cities, don't know, but you've got a map there. That's the latest number of cases around Chinese provinces, and as you can see, there's plenty. And it's growing every single day. Of course, we've seen it already make its way to various other nations, Thailand, Japan, the US, as you mentioned. Hong Kong has now got 2 announced today, so we'll continue to see that expand as well. So, we have the early stages of a pandemic, and so China needs to move, and it is. So if you want to flip to the next tile. Firstly, I mean, it's just a simple point to make that, there was a lot of political fallout from the early failure of SARS. And so, the CCP is going to have to stomp on this hard, even though it's not as toxic as SARS. But it is a political necessity that they do it, so we can expect it to go very hard now that it's, the cat's out of the bag, as it were. So we've seen the leading edge of that we've had a few weeks of dithering, not quite as much as there was around the SARS epidemic, but still pretty slow response. I think that a lot of the press around it being a swift response is wrong. The timeline doesn't look that much different to SARS. There's already rumours of a possible serious trouble for Wuhan officials who are being blamed for burying the truth. And as a result, their city of 11 million people is now a quarantine zone as of this morning, which is actually more draconian than anything we saw during the SARS outbreak, as far as I can recall.
Yeah, and I guess so. The flip side is the SARS outbreak was pretty much gone from, it was out in the wild by the time you started getting official measures. Whereas at least now there's I guess
there's an epicentre at the moment.
Yeah, that's right.
Yeah, that's true. Although there were epicentres in the SARS outbreak as well. I mean, it was Wuhan again, and Guangzhou, and then eventually Beijing were the 3 main ones. But yes, there is an epicentre right now, and it's been shut down and no travel allowed. Indeed, there's the last plane, I think, that left Wuhan this morning flew to Australia, and it's been accosted on arrival, and everybody's been processed through various health checks. So, we can see here is in terms of how it measures up against SARS, because it got out a little wider, a little earlier in the SARS case, rather than a quite so obvious and specific location getting smashed. There are a lot of small-scale people gathering shutdowns in all of the affected areas and right across China, for that matter. There's a lot of sort of social media leaking out around this kind of thing happening in the private sector already this time around, where people being asked to stay home, work from home, etc. But during SARS, China shut cinemas, theatres, shopping centres, like all sorts of any kind of public forum where you got people-to-people contact was shut down, and so I think we can expect a similar approach wherever this one pops up. And as I said, I think the private sector is going to do a lot of it au natural. Anyway, some of it panic, some of it sensible. And so, the process of containment will probably succeed. I mean, the one advantage that China has in this thing is it can quarantine a city
Yep.
of 11 million people.
Yep.
Arguably, that's really only the flip side of the coin insofar as other freer societies would probably have to address these things earlier. And so I wouldn't say it's an advantage necessarily. It's just they're slow to respond because
Creating their own problems in a way.
yeah, they go create their own problems, but then the draconian system has its solution as well.
Yep.
So I'm sure they will contain it eventually.
Well, we're relatively confident.
Well, yes.
Yes.
I mean, using the SARS analogue,
Yes.
they will. I think the politics says they have to, and I don't think that they'll stop until... I don't think they'll be play a Scott Morrison and worry about job losses.
Yep.
When a crisis comes along in the national interest and needs to be addressed, they'll just address it. So, therefore, I think we can expect damage, economic harm
Absolutely.
to come from this.
Yep.
So if you want to swing over to our next tile there, we can explore what that might mean. So a quick run through again, some terrific material here from UBS, which parses the SARS experience again. And it was pretty severe economic harm, but it was short and sharp. Growth fell quarter on quarter from 12 to 3.5% at the peak of the SARS epidemic. But then it rebounded, very quickly.
Yep.
And
we should just put this in context as well, though, is that this was the start of the big boom that sort of led into the financial crisis. It was just the early days of that really starting to tick off, and so in China in particular, lots of investment going on, lots of new debt, lots of projects, lots of good investment projects that generated good returns, and even elsewhere in the world, it was just a start. It was the end of that, the market sort of turning down from the prior crash that we'd had around the tech boom in 2000 and in 2000, sort of drifting markets downward, and it was just the start of this massive upswing. So in terms of timing, it's very different, and that's what I'm getting to. I was getting to in that lead-in is saying, well, if you have quite fragile economies and then they get hit by, as you saw in China had a down from 12% annualized to 3% annualized. If you're already getting into this boom stage, it's much easier to shrug that off than what it is if you're struggling to find growth.
Well, I mean, if you're growing at 6, we drop into 1 or 2. If you get a similar sized hit for a quarter, and I'll come back to that in a sec. You can see that the damages to all of the kind of sectors you'd expect. Travel is absolutely smashed. Retail gets hit really hard. Tourism, etc. If you want to flip over, we can see the next bit. More investment focused stuff is stronger through the crisis, but it also takes a hit. And then they tend to respond in the way you'd expect as well, with either monetary or fiscal easing of one form or another. But this brings us back to Damo's point, which is, if we had a commensurately sized shock with SARS this year, relative to the much larger Chinese economy, then your growth is going to fall a lot further, and the stimulus options these days are much more limited. As Damo said, back then China was just an absolute, in one sense, wasteland, and in the other sense, just ripe for, any number of brilliant investment projects. It was so easy to grow, it wasn't funny. Whereas today, it's much more over-invested. There are very few, good return projects left. Obviously, it's debt saturated, and so they're trying to deleverage. So, how much kind of stimulus can they throw at it, and how quickly would it rebound? Not as much as during SARS, and not it wouldn't rebound as quickly either. So if we get a similar size shock, we think it would be more lingering, it would rebound more or less to where we were, but probably take another quarter or two. So swinging over to our next tile, and we move on and look at, the fallout for the globe and particularly Australia. So the first thing to note, of course, is all of those tourism and retail impacts will have immediate spillovers to everywhere else, especially Australia, because we're so dependent on Chinese tourism these days. And as you can see on this chart here, back in the day of SARS, we didn't have that many North Asian. Well, we had good North Asian tourism, but a lot of that was Japan. And these days, it's almost half our total tourism dollar and numbers. And so if
from China, sorry.
From China. Yep. So we're going to see a huge hit for tourism. The SARS analogue is somewhat useful. I think during the crisis, the sort of April-May period of 2003, Australian tourism international bookings fell about 10%, but that was on a much lower base of Chinese tourists. So you can expect that to hit again if it develops in the way that we're discussing and foreseeing.
The other possibility, though, David, is that you find there's more people in China who want to get out of China and get to somewhere else.
Yeah.
For a period of time.
Maybe, yeah.
Yeah.
I don't know.
You mean from a tourism point of view?
Tourism and students as well, saying, well, thinking about sending my child to Beijing University.
But you do have to get on a plane to get there, right? And you've got to breathe other Chinese air.
Yeah, sure. But I guess what I'm saying is there is a potential that, I guess what I'm saying is we don't know for sure what the
we don't know for sure, but
impact is going to be.
But I reckon it'll be negative.
I think you're right, but I guess it's an uncertainty that's not
So likely, I'd put it as and same,
and it is likely. I guess for the experience from SARS was it's likely that. All travel, globally, gets wound back. I guess that's probably a bigger issue in terms of
absolutely.
People who are thinking about taking an overseas holiday and outbreak of SARS or whatever it is, then go, well, maybe I'll just holiday nearby. I don't need to go.
Make life
and markets are one market that has at least started to price the impacts here is oil. It's been falling on the back of downgrades to high octane petrol, basically for aircraft. So students much the same, I think. Similar dynamics at play. Commodity prices, are really interesting. LNG is obviously connected to oil, so I think what was shaping as a very nasty year is going to get worse still.
Having said LNG, that's more harm to the companies involved, which tend to be international
it would actually be a benefit,
a net benefit to the Australian
for Australian economy.
Yeah, which is that. Yeah, as just to put that in for anyone who doesn't listen to David stand on his soapbox and yell into the ether about the LNG is that our issues with high LNG prices is it doesn't flow through to the rest of the Australian economy, and it's actually a negative. The high LNG prices actually cause...
Well, it does flow through. It just flows through as higher energy prices.
Yeah, there's no benefit
rather than higher income.
Yeah, whereas when the iron ore price goes up, the royalty stream paid to the government goes up. Maybe there's a small bit comes through as jobs and dividends, but most of it's most of the iron ore... Sorry, an increase in iron ore price benefits the Australian economy, whereas our conjecture is that the LNG price... the profits come in and go straight back out to foreign companies.
They pay no tax. There's no new jobs.
Yep.
And our power costs more.
Yes.
Exactly.
So net negative.
So the falling price is actually a good thing.
Fair enough.
And then two coals are already on a bit of a hiding this year. Coking coal price is weak. It's had a bit of a rebound, but still weak, I think. Largely, or at least one reason why is Chinese bans for Aussie coals, and I don't think that coronavirus is going to help that. And iron ore, of course, is the big one. We've seen some amazing pricing action in the iron ore market in the last week, especially in iron ore miners, and they've been going absolutely berserk upwards as this has gotten worse. I just find that hysterical. I do think iron ore will be negatively impacted for a quarter or two. And if it is impacted negatively out to mid-year, then you're into, Vale's new volumes as well that are coming back as the supply normalisation transpires after the Vale accident last year that has kept the iron ore price very elevated. So you could argue that we're at peak iron ore and it's coming earlier because of the coronavirus for 2020. So in short, as the year plays out, that's not, at the moment the commodity prices are all a tailwind for the budget because even though coals have fallen away, iron ore is so high that it's offset that and more. But this won't aid keeping that sustainable. So it'll be a problem further into the year. And so all of that adds up to Australia. We already have really crappy growth, barely growing at all, if at all, in per capita terms. GDP is 1.8 in the last quarter, annualised. Not annualised, but over the year to the December quarter. So it's September quarter. Can't remember.
September.
Yep.
September it will be, yeah. And I don't see that accelerating at all. That's not quite stall speed, but it's close. And then you've got the bushfire shock, which is obviously going to hurt consumption at minimum.
And travel.
It's already really hurt tourism, and now we're going to double down with a second shock, especially for tourism. And won't help those commodity prices as the year unfolds. So, that adds up to more pressure on the RBA to cut, more pressure on the government to throw away its absurd surplus. I don't think on the latter they will. I think they're, for whatever reason, not going to do that. But I do think the RBA is going to be forced to cut twice in the first half of the year. Whether they go next week is really in the lap of the gods. It was a weak jobs report today, but maybe not quite weak enough. But the leading indicators on the labour market are pretty sour, and so I think unemployment will rise over the first half of the year, and this will make this worse at the margin, and so more RBA action basically. Probably therefore also accelerates the possibility of quantitative easing in the second half. So just for Australia, it's making a difficult economy more difficult. Probably, not recessionary or anything, but tough. Yeah.
Okay. All right. Sure.
And the risks, it increases the risks of a recession. I think it's probably the better. It's not recession on its own, but we've spoken a few times about saying there's a sort of relatively fragile psyche, and Australians are definitely trying to deleverage. We've got a government that's trying to get them to leverage up.
Yep.
That's pretty much the only economic plan they have is trying to get people to borrow more and get house prices going up and hoping that'll flow through the rest of the economy. And so if you have sort of these negative consumer confidence hits, people don't spend as much, less confident about getting new loans, and whether it's just that you've had relatively weak wage growth and bushfires and cutback in tourism, is this enough to be the domino that finally tips it over and off you go? Yep. Maybe. It's not something we're going to commit to, but it's certainly well worth watching and well worth being considered of.
Yep. Okay. Very good. All right. So we'll jump across now into investment implications, and then we've got a question at the end as well. So kicking off with equities, how?
Well, again, we've just got the SARS analogue here to kick us off with equities. I mean, we all know that the Australian equity market has been running wild and is incredibly overvalued at the moment, and that's not the kind of environment you want to see a shock like this. So here we have, basically the period of the SARS crisis in 2002 and 2003. And you can see that markets fell for a couple of months, both across Asia and in the US. the US ended up with 30-something, I think, SARS cases itself in 2003. A few interesting points of note. Basically, the US rebounded very quickly by about mid-March, which was long before the peak crisis, which wasn't until really late April in China. And so, once the US markets were confident that SARS was contained there, they were happy to sort of bid up and run on.
Yep.
That said, this was the tail end of the Millennium tech bust.
That's right.
And so markets were cheap, and the SARS sell-off was actually the end of that bust. Like, it marked the bottom. So arguably it extended that sell-off a little and just cleaned out, the bears.
Yep.
Then markets took off and ran sort of straight up to the GFC, with US housing and etc. That's all history. So it's not a strictly speaking accurate analogue, because the S&P 500 today is extremely highly valued.
All-time highs.
And so, the potential is there if China were to shock enough. And it's so much bigger now. In this 2003 period, it was the size of the Australian economy today. And it's now nearly 10 times bigger. And is a massive contributor to global growth, and we all know that story. So a comparable size shock to SARS, to Chinese growth, could hit.
That'd be recessionary for the world. Well, certainly for one quarter.
For one quarter, and would be enough, I think, to cause a material correction in those sky-high equity prices.
Yes.
And you don't know, they may not... Look, it's probably a buying opportunity, but you just... Because they're so highly valued and priced to perfection, you're not sure how quickly... where the bottom will be on that correction, but, the prospect for it is definitely there. There'll be some... limits to the damage through bonds, which are already bid, especially in Australia. Like the Aussie bond market is bid strongly, has been since the crisis really sort of metastasised. And, yields are at 2020 lows. We're already, the yield curve is still inverted out to the 5-year here. It's still indicating a high possibility of recession. That's probably going to get worse. And as the RBA is forced to cut, I think that there'll be a pretty wild bond bid here over the first half of the year. I wouldn't be at all surprised to see new
lows,
highs or lows in yields, highs in prices, and that may prove some support for equity prices, which are leveraging off such low interest rates. Especially if that were to transpire in the US as well, where it has what looks like a pretty good mini cycle in housing underway, recovery over the last 3 to 6 months because the Fed, started to cut. And if US bond yields were to fall, that would drop the mortgage rates even lower, and I think you would see a very strong response in the US mortgage market.
It's worth this, I guess, giving that a little bit of context as well, in terms of the way David's talking about the equity market being affected, is that it is a little bit binary again, where if bond yields are going down because they're concerned about economic slowdown and other factors, and to a certain extent that lets equities go up, and because equities go, now it's cheaper to get funding, and we're stuck in this low growth environment, and where else are you going to put your money? Yep. But at a certain stage, if you do get enough negative effects, and you're looking at a quite sizable shock to global economies, that's when equities then take a quick leg down.
Sure.
So it's sort of like as long as things are just a little bit bad, it's probably a good thing for equities. Yep. Net, or slightly good, not from that valuation perspective. But if it gets too large, then you'll see a sudden and sharp correction in equity markets.
Yeah. So equities are fine as long as they only have to look at bonds. Yep. If they have to look at the real world, then
macro,
then it'll be a real problem.
Okay. Yep.
Interesting. And that's where the analogy is, as David keeps on saying, we need to keep remembering China's 10 times larger.
Yep.
It has really been driving world growth, and we're sitting on huge debt piles in corporate markets. So if this starts flowing through to some of those, there's as we say a few times, there's lots of dry tinder around. Could this be the spark that lights the fire there? It could be. And so where David's talking about, look, maybe it'll drift up. I certainly wouldn't be looking at this as saying, oh, here's an opportunity to make some quick, easy money in equities.
Yep.
We're sort of looking more the opposite way, as saying, well,
A bit more long term. Yep.
well, and more just recognising the downside, as saying, yeah, look, I might be able to pick up a couple of percent on the upside with a risk of 5, 10, 20% downside, depending upon how severe it is.
Yep.
You're saying, well, is that really worth it at this point in the
Pennies
cycle?
in front of the bulldozer sort of thing.
Yeah. My point was more that the bond yields might support on the downside, not that they would drift up. But as you say, there's a tipping point in that.
Yes.
If yields are going to fall that much, then they're doing it for a reason, and that reason is going to land on earnings.
Yep.
Before very long. So basically, I think Australia is at much greater risk of economic harm here than the US, and so the RBA is relatively much more likely to move. I think it was going to move anyway, but even more so. And so you've got implicit pressure on the Australian dollar.
Yep.
Unfolding as these various markets respond to whatever degree of shock this turns out to be. And so that's some downside protection as well, obviously, especially for our portfolios because we're heavily overweight international.
Yep.
Yeah.
And underweight Aussie. Probably not a bad. Yeah. So in terms of what we're doing, Damien, largely.
Yeah. So look, we've been the last couple of months. We've sort of been we've been adding a little bit of equities here and there as sort of things are clearing and not heaps, but in terms of international equities and
where there was value, UK, etc.
But we've been looking for an excuse to take the top off of a number of stocks. I think we've probably trotted it out a few times, but there's plenty of names in the portfolio that are up 30, 40, 50% in the last year, and something like an Apple, biggest stock in the portfolio is up 120 something percent, and so
Remarkable.
there's lots of areas where we've been looking for an excuse to take the top off, and we're using this as that excuse to sort of just take the top off, and a bit of a watching brief to make sure that if it does look like it's going to start running away, is that we can do a fair bit more in terms of
start shifting out,
going more defensive.
Yep. Well put. Yeah, very well said.
Oh, sorry. Actually, I should say on the bond side as well.
Yeah, good one.
So the bonds. So the 10-year bond yield in Australia got down sort of below 1% there, and that was we'd been selling out of the bonds. We were heavily overweight at the start of the year, and as those bonds, the bond prices went up and the yields went down, we were selling out throughout the year, and we sort of pretty much about a market weight position, maybe a little bit overweight. Then the bond yields turned sort of late last year and early into this year, and really ran up to sort of about a 1.4, I think maybe it hit, certainly 1.3.
I think the 10 got to almost 1.5, 1.48, something like that.
And so, and we used that as a chance to sort of start reloading some of the bond positions.
Okay.
Having said that, we were just getting started, and then bond yields fell away again, and sort of in the current ranges, we're sort of happy just to sit where we are. If they keep going down, we'll probably start winding those bond positions back out again.
Yep.
It's not you're not making bucket loads of money, but our sort of view is that closer to 1.5%. We're a buyer of bonds.
Yep.
Closer to 1%. We're starting to get to at least want to get back to sort of a more market weight position.
Okay. Yep. Sure thing. All right. Fantastic. And I'll just finish up on a question we've got from a listener in at the moment, Mark. Thanks for holding on. And this is probably a little bit more of a Davos than a coronavirus question, but what is your view on the potential influx of climate refugees, both globally and in Australia, and what are the political and economic implications? I think there's almost a podcast topic in itself on that one, but
Lordy. Well, I mean, if we're to believe the science, I don't know why I even phrase it that way, frankly, because I do. It's worse than it appears, and so certainly by mid-century and certainly by end of century, we're going to see very large populations displaced, And
Given the most recent activity in Australia, that might be us.
possibly. And some of that's going to hit Australia most definitely. I'm thinking here of low-lying areas across Asia and the Indian subcontinent, and we're talking tens and tens of millions of people here on the move, and so there's going to be, as there is today, huge movements of people illegally across these oceans, and we know how Australia responds to that pretty negatively.
We might almost cut this. I think this is. We're probably going to do a disservice. We probably should do this.
Yes,
in
a topic for
a
another
lot more
time.
depth.
Yep.
I think there's
It's true.
it's
It's going to be a problem.
Yeah, but I think to go into the details of it is probably
We'll break it apart for you, Mark, and perhaps it can be a topic of another podcast.
Yeah, fair enough.
Very good. Thanks, gents. So speaking of which, coming up next week, we have Dr. Stephen Hale, who's a lecturer School of Economics at the School of Economics for the University of Adelaide. He is a modern monetary theory economist and specialist in Australia. He was unwell this week for those that follow the podcast regularly. We've confirmed that he hasn't had anything to do with China recently, so he will be on the show. We'll be speaking to him early next week, and we'll be bringing that to you. And just as a note, Stephen was actually suggested guest by a listener. And so if you do have any future topics or guest suggestions, please feel free to drop them into the comments below, and we'll take some action on those.
We do have a question.
One more question, okay. Okay, back onto the coronavirus. Thank you, Peach. How many people do you think have to die from the virus for this to become a global emergency with a major dislocation rather than what it seems to be now, which is a storm in a teacup whipped up by the media? So is there... It's quite interesting.
Well, SARS got to 700.
There are 800 deaths from SARS.
So we're on the path to it, and I guess that's the big issue. Is he's completely right in that if they turn around and say, look, no more death, we've managed to cut it back. There's been no more deaths or relatively limited deaths, and especially if they're limited to sort of that central China, Wuhan area. If though it turns into I'd say in the next couple of weeks, if it turns into 300 or 400 deaths around a much broader...
It's not going to need to be that many. If the mortality rate stays at 2% and it keeps spreading, it's on like Donkey Kong.
Yep.
Yeah.
It's really that simple. I wouldn't put it in aggregate number terms. You don't quarantine a city of 11 million people as a media beat up.
Yep.
Leave it at that.
Yep, fair point. Okay, no worries. Well, thanks very much, gentlemen. And on that note... Well, that's it for now, and thanks for watching. If you like what you heard today and you'd like to hear more, head over to nucleuswealth.com/subscribe. Give us your email address, and in return, we'll send you a weekly email with new webinar topics, links for our podcasts, and other news from Nucleus Wealth. I certainly hope you've got something out of today, as I have, and we'll look forward to catching you at the next one. Cheers.